All right, what's going on, guys? Today what I wanted to talk about is assumable mortgages. And so I know it was a popular thing a little while ago with the market and with rates continue to probably increase here. They may be coming back and you may start hearing more and more questions about assumable mortgages as we're looking for a way, how can we buy in this market with interest rates going up? And so today, what I'm going to cover is what is it, who has it, and where can we find it. And so, not many lenders, of course, are going to be talking about or pushing a assumable mortgage because obviously, once we get to it, I'll show you that essentially the assumable mortgage is kind of cutting out the lender per se. And so, you're not going to hear it, when you say, hey, I want to buy a home, a lender is not going to really talk to you about a assumable mortgage. So that's why I want to bring this information to you and kind of talk about that and get that information out to you. So what is a assumable mortgage? It's essentially a loan that the seller has that the seller can transfer their loan to you. So as you know that, from a few years ago, people had very low interest rates. So a assumable mortgage allows the seller to transfer that complete loan over to you, the buyer, and you are now able to get in at that lower interest rate, whether it's 3%, 4%, whatever that current seller has on the current loan. You're actually able to take that over. They can transfer the loan to you. You keep the same loan terms, you keep the same period, the same interest rate. All that information stays the same. Now, what you're going to find is, how do you know if the loan or if the mortgage is assumable? So if the seller has a FHA loan, a VA loan, or a USDA loan, in most cases, the loan is assumable because on most of those loan types, they are assumable mortgages. And so even if the seller has a VA loan and you as the buyer, you're not a veteran, you still can assume a VA loan. And so there's some great advantages as a buyer to being able to do that. So what does that process look like? So essentially, the seller is going to contact their mortgage company, whoever that mortgage company is. They're going to say, hey, can I get the paperwork? Or first you need to verify that, yes, is my loan assumable? From there, what's going to happen is you can request a package of information, a assumable mortgage package from your lender or from the mortgage company. They will get that information to you as a seller. Then from there, you are now able to go, you're going to fill in the buyer's information. You're going to send that back to them. And what's going to happen is the mortgage company will now contact the buyer. They have to contact the buyer because now they have to approve you for whatever loan terms are currently on there. They have to make sure that the buyer can assume that loan and is approved for it. So once you have that information, the mortgage company approves you for it. Now you do want to keep in mind that as the buyer and even the seller, this process to go through a assumable loan and transfer that over, I would say probably you want to give yourself at least 45, maybe 60 days from start to finish to go through that process. So you want to make sure you have time. Now, just so we could understand what that looks like is, as you can see from the example, we're going to start with, let's say the seller wants to list a home for $400,000. Okay. And now the current loan, as far as what the current loan is, what you're going to assume is, we'll say a loan balance of $300,000. So from there, right now as a buyer, you're going to need to close the gap or basically bring to closing the extra $100,000. So you assume their loan at their interest rate for $300,000, and now you're bringing in $100,000 because they're listing it at 4 and they're bringing in, and the loan amount is 3. So you're bringing in the extra $100,000 to close the deal. Now, there are some options that you can do as far as to help close that. If you don't have the $100,000, you can look at possibly getting finance for a second mortgage. So you have your first and then you get the financing on the second. That's where you're going to want to run the numbers to see, if it all makes sense, because of course a second mortgage, the interest rates are going to be higher. You're going to pay more for a second mortgage. And so you do want to make sure that the numbers make sense by the time you factor in the $300,000 or the $100,000 on the second, and then what you're assuming. You want to make sure as a buyer that those numbers make sense for you. Now, some of the closing advantages of having an assumable mortgage, or basically going through this process, is even as a seller, closing costs are going to be lower. Or I'm sorry, as a buyer, closing costs are also going to be lower. So that's also an advantage to look into a assumable mortgage and why, that may be a good option for you. Now, as far as where you can go to find an assumable mortgage? So what you're going to do is, as the buyer, once you are pre-approved and you're out looking at homes, the next thing you're going to do now is when it goes, you're going to ask the listing agent of that home. So you'll talk with your agent. You'll have your agent ask the listing agent and say, hey, what kind of loan does the seller have? And then is it assumable? So just because they may have a FHA loan, USDA loan, or a VA loan, they still have to confirm with the mortgage company that it is assumable. And so what you do is, as you're looking at a home, you say, hey, I think we like this home. We want to put an offer in, and let's look at some options of if we can assume it. You want to talk with the listing agent, and you want to simply ask them, hey, is that an option? What kind of loan do they have? Is a assumable loan possible for the seller? And so that's where they're probably not going to know offhand, but they will be able to check with their seller, with their client, and confirm with the mortgage company if their loan is assumable. So in this market, there are a lot of different things that we definitely have to get creative with, especially with, interest rates going up. There's some reports that they may continue to rise for the next quarter or so. So we do have to keep in mind, we're looking for ways of how we can creatively look to buy in this market with interest rates going up. Assumable mortgage may be an option. Like I said, it's good to run those numbers, make sure you evaluate them and see if it makes sense. If you have cash on hand, definitely looking at the assumable loan option is definitely a good way to go. If you have any other questions, don't hesitate to contact me.